Hi, everybody. Time to talk about one of my favorite subjects is trade. Some may think trade. How could trade be an interesting, exciting kind of subject? Well, trade is interesting because of what it does for our world. We'll see that about 30% of the United States GDP, gross domestic product, is related to trade, both imports and exports combined into trade. So for those people who denigrate or find that trade isn't as beneficial to the United States, quite a large percentage of our GDP is related to trade. Without trade, it would be a much different world, in fact. And in fact, when you look at the 1800s, only about 2% of our world was related to trade. 2%. Today, upwards of 30% of our world is in some type of trade. In fact, about 60 to 70% of all products made throughout the world are susceptible to trade, which means one country or another could both buy and sell it. So just about anything we make can be traded throughout the world. That stands to reason, of course. Some countries have more of one thing and less than another. Saudi Arabia, for instance, has a tremendous amount of oil. I think about 50% of their economy is related to some type of oil. They also related to petrochemicals and other types of chemicals that is a derivative of oil. Some countries have no oil at all. In fact, Japan is one of those kind of landlocked countries, not in terms of physical presence, though, mainly because they don't have very many resources in that country. So they have to import a lot of the resources. Then they have to use technology, which is where you advance or you change something, and then they change that importing of raw materials into the exporting of some type of good or service, typically good. That's how they got so good at cars. They did very well because they imported a lot of the materials and they developed processes that allowed them to make cars in a much quicker type of format in a more efficient manner. And also the quality was almost unmatched. They had a person by the name of Edward Deming, W. Edward Deming, his full name, and he helped train and guide Japan into how best to produce products that was going to create really the behemoth that they become. It's true not everyone gains from trade. Some countries gain more than others. For instance, the United States doesn't gain as much from trade in the European Union. They certainly don't gain as much with China. China imports many more products into the United States than the United States exports into China. Part of, as we have learned about trade, is over the years, had the United States not done that for a number of years, China would not have had the monies to build their economy to what it has become today. We all predict that China is going to be, if all things remain consistent, is going to be the largest economic power in the world for the foreseeable future. As the United States was to the 20th century, we expect China to be that for the 21st century, all things being equal. Every country has something that they're good at. We call that a comparative advantage, and that is really the underlying principle related to trade. Saudi Arabia is good at oil. They have the raw materials, but then they can also produce it. They can produce many other products related to oil. So because of that, they have what's called a comparative or competitive advantage. The United States is good at a number of things, which we'll talk about in just a bit. And that allows them to be beneficial, advantageous in some areas, but not in others. For instance, in medicines, the United States typically leads the world in the development of medicines. We have a pretty good healthcare system here. We have a healthcare system that, as it's often said, it's the best healthcare system that nobody can afford. But it is a good system. What are some of the benefits of trade besides the tremendous growth in economies? Is transmission of ideas too. There's things that happen in Poland and Romania that now we're aware of in other parts of the world, and as a result of being aware of that, we can build upon those types of ideas. We may not have determined the idea in the first place, but maybe we're able to build upon it based on our understanding of the idea someplace, somewhere that has occurred. Often called serendipity, I believe, which is where something comes up out of something else that you've seen. So we've had this plethora of new goods, services, and processes spread throughout the world because we've become more aware. We've become more aware because of telecommunications. Telecommunications has occurred because of, obviously, technology. Technology has been the big growth and mainly one of the principal reasons why trade has exploded over the last few decades. That and technology and transportation and telecommunication. I call them the 3 T's. Those really have been the root of the dramatic escalation in our world over the last 20 to 40 years. It's been a good time, actually. It's been a good time for somebody looking for a job, trying to create some type of business. There's goods and bads, of course, and some countries gain through trade and some maybe lose a bit. Make no mistake that all countries benefit through trade. All countries do. Some can benefit a little more than others. For instance, if a country does nothing more than to export their goods and they don't allow any imports, they could develop a market within their country that does quite well. However, at some point, when your economy grows as a nation, you want to have some products that other countries produce. Maybe you want to have some type of wine from France or chocolate from Switzerland. Chocolate that's better than in the country that you live. And so you may want to start importing. You become more aware. Remember I talked about that awareness. You become more aware of what occurs at other countries. And you want to be a part of that. You want to import some of those goods. At some time, after you've exported quite a bit, you do still now want to import. There's products and services throughout the world that you're aware of that you want to try. So exports are usually followed by imports in some way or fashion. Countries, for the most part, don't want to have as many imports as they do exports. They want to be able to bring more money into the country, which is what you do with an export, as opposed to money's going out of the country, which is what you do when you import. If you buy chocolate from Switzerland, you get the chocolate, Switzerland gets the money. What does Switzerland do with that money? They invest it in education and telecommunications and infrastructure to rebuild and build their country. And therefore, your monies from your country that go to a different country, that different country is able to build a stronger country. That's why, in essence, exports are always more favored by a country than imports. However, you can't have exports for the long term without imports. You can't continually spend your money and send your money to other countries and expect over time that those other countries are going to have the kinds of monies needed to buy your products. You need other countries to grow their country as best as they can so that they can continue to buy from you. Part of the way that they do that is they need to export as well. The issue is to what level. Some years ago, the U.S. government slashed tariffs, which are taxes on items imported from other countries. For the following 10 years, the dollar cut of flowers imported to the U.S. from Colombia quadrupled. Colombia sent more flowers in. California growers responded by lobbying Congress to restore the original higher tariffs. They could not compete. And as a result, many people growing flowers in California went out of business because they couldn't compete with the prices of those flowers coming in from Colombia. Remember, at the time that you cut a flower, it can be into the United States within later that day. So if there weren't some tariffs, many of the flower growers in California would have been out of business. Some would say they should go out of business. If they can't produce a flower that is cheaper than Colombia, then they should go out of business. Remember, though, thousands of people have a job in California because of the flower industry. If you run them out of business, those people don't have jobs. People have jobs, pay taxes. Those taxes support schools and police. So you can see the ripple effect of eliminating the flower industry within California. Remember, too, that in California it's much more expensive to live. So some of the prices that California growers charge for flowers may not be unreasonable given that their costs are so much higher. taxes are higher in California. As a result, people who are making flowers, growing flowers, are going to have to pay more to the government. So which means they have to raise their price so that they can pay for their bills and also make a profit. People in Colombia may not have those taxes, so they're able to lower the cost of their flowers. Yes, they lower the cost of the flowers, and they're still cheaper when they came into the United States because transportation costs have fallen considerably over the years. There is a relationship between exports and imports, and I did talk about this. If you do raise tariffs, for instance, within the flower industry, it is true that the Colombia prices for flowers would increase, and maybe some people in the United States would keep their jobs. However, Colombia would not be pleased at that. And maybe there are some imports from the United States into Colombia that Colombia says, well, if you're going to put some kind of tariff or tax on our flowers, we're going to put a tariff or tax on what you import into Colombia. And let's just say it's the broom manufacturer. The broom manufacturer may be able to produce their brooms much cheaper. But now Colombia has instituted a tax on their goods. So their tax has now made their brooms more expensive. What happens as a result? The broom manufacturer in the United States may not be as competitive in Colombia. They may lose jobs because they can't sell as many brooms in Colombia because Colombia has raised the price of their brooms because the United States has raised the cost of Colombia's flowers. You do this, we do that. So although the flower manufacturers may have kept their jobs in California, the broom manufacturer has lost their jobs. That's why, ultimately, a prohibition or some type of restrictions on imports and exports doesn't really save jobs in the U.S. In the long term, as we mentioned, imports are paid for by exports. If we don't export and we also import, then there's not money going out and going in to another country. We have, over the years, we meaning the United States, have really allowed other countries to take advantage of us, to use imports and tariffs in order to manipulate the price of their goods so that they can compete more favorably against U.S. goods. The end result has been that we have lost out in a way. We haven't been able to export as much as we would have liked. Our hope is that these other countries are building their economies so that eventually, as they develop a middle class or an upper class, they will want to buy U.S. products. And now that they have exported for so many years, they have the monies to do that. Nations do benefit from free trade because any restrictions on imports will ultimately reduce exports. Ultimately, not in the short term. In the short term, the country may advance itself quite considerably, but at some point, they want to continue to export. They want other countries to continue to buy their products. But if other countries don't have the monies, because all they've done is bought products, they haven't invested in education, they haven't invested in infrastructure, they haven't built a telecommunications or transportation industry, they may not be as competitive because over time, all they've done is send money overseas rather than investing in their own country. Remember I talked about the flower growers? You can see that when the United States in the early 2000s started to slash tariff rates on goods imported into the United States. What happened was U.S. flower growers really started to take some advantages. They started to increase their market share. They made more money, more profits. They artificially influenced the price of Colombia flowers, and as a result, it benefited U.S. producers. Importantly, let's talk about why it's so much more difficult for U.S. producers to compete. It's not just because of higher wages. People in Colombia make upwards of 10 cents on the dollar that people in the United States. So if you're making flowers, growing flowers in the United States, your cost for labor could be quadruple or more than the cost of labor in Colombia. Taxes are higher in the United States. Regulations are higher. To have a product in the United States, the regulations by the government are extremely burdensome. Any kind of regulation has costs. There's many laws that you have to follow, regulations, statutes. All of those increase the cost of a product the U.S. is trying to sell. That's why in so many instances, the U.S. is not competitive vis-a-vis other countries because our standard of living is much higher. Therefore, our costs are much higher. We hear about Nike and others building shoes and other types of products in other countries. They do that because it's much cheaper. Even when you have to pay transportation costs to bring the product back, it still is cheaper to produce it in other countries. So flower growers, when they, as this slide shows, as they started to eliminate some of those tariffs, their goods and services started to drop because they weren't as competitive. They were really only artificially competitive, and that's an important point. They weren't as competitive as you think they would be. They were only competitive because there was restrictions in one way or another on other countries in relation to flowers. There's another example in African nations. In 2000, U.S. passed the African Growth and Opportunity Act. All of these acts that the government's passed sound so great, even if they're not necessarily great to one area or another, one state to another. They all sound great. The Affordable Care Act sounds great, right? The Patriot Act, all of those kinds of aspects have just a name that's like, how could you vote against it? This is a side. Anyway, it reduced tariffs faced by African companies exporting goods and services. The result has been African-U.S. trade has risen considerably, more so on the African side. African nations have been able to export more goods to the United States. They haven't been able to buy as much from the U.S. because their standard of living is so much lower. They don't have as much monies. The hope is that over time, Africa would use these monies to invest in their economies, and eventually you're going to have a whole host of middle-class people in Africa who are going to be looking favorably upon U.S. goods and services. European linens is another example. And this example is where you use the advantages that you have as a country. The production of linen, I didn't know this, requires twice as much land and labor as the production of equivalent amount of cotton. 2/3 of the world's linen is from flax seeds. It's harvested in northern France and the Netherlands, 2/3. So some people say, why? It's the coastal climate. It provides alternating sunshines and rains that provides an optimal environment. And they're able to produce this flax at a lower cost. So they have a natural advantage over any other country that wants to produce linens. The goal then is for this country to produce linens, to not produce other things, at least in this area, because they're good at it. They can produce linens of exceptional quality, and they should continue to do so. To not use the weather that is a natural advantage to them in those areas, to not use their weather could be highly disadvantageous to those countries. Has the United States benefited? It has. Has it benefited as much as other countries? The answer is probably no. Will it over the long term? The hope is it will. Remember, I said in the 1800s, only about 2% of the world GDP was related to an import or export. Now it's about 28-30%. It means 30 cents of every dollar that we spend is based on an import or an export. We've all seen the Made in China sign on just about everything we bought, especially in terms of communications. They're very good at it. The United States is good at other areas too, mainly because we have an entrepreneurial spirit. We are really a nation of small businesses. Small businesses become large business, we hope, over the long term. We've also had quite a bit of economic restructuring. In some ways, it's good when a business doesn't do well. Business has to cease to exist. And we have to create a new business to take over. It just means that this company and this country was good at something for a while, but wasn't good at it for a long while. And they need to move their resources to something that they're good at. It's economic restructuring. The average business is only in business 10 years. The average person works in business 4. We need to keep moving. There's a great saying that says, fail fast, fix it, and move on. We do have a sophisticated financial system, as does London. As a result, New York, the Wall Street, is one of the most advanced mechanisms for finance in the world. When people want to borrow money or to work on some type of sound financial system, they do so often in the United States, not just because we have as much money here as any other country. It means that we have the tools and the strategies and techniques to develop financial instruments that would be more favorable to companies. We still do have large investments in scientific research. We certainly lead the edge in terms of what we produce, what we could produce, and what we're planning to produce, which is scientific research. International trade. And I'll close with this. We have benefited greatly through international trade. World GDP is 9 times greater than World War II. 9 times greater trade. We know that world trade has increased 28 times more than in 1950. Remember, it was 2% in 1800s. GDP has grown, and trade is a key component of that. If you look just in the 1950s, just for the US, the percentage of GDP, we look at about 10% of our economy was related to some type of import or export. Now we see, some time ago, about 10 years ago, that we were about 32% of our economy was either a good or a service that was exported or imported. So is trade important? It's one of the most vital aspects that we have as a country. To start a trade war, as they call it, where we start saying we're not going to import your goods because it's not fair. If we were to do that, then others would retaliate, and it would certainly be disadvantageous to us. But there are aspects that are disadvantageous to us. For instance, if we look at the trade between China and the United States, which is at the bottom, we send about 860 billion in goods to China. China spends about 1.7 trillion. By the way, that is in the Pacific sphere, mainly China. Same with Europe. Our trade is about 1.66 versus 1.17. It's amazing the numbers that would go away if we did not trade as a country. We know that there are some arguments against free trade, no doubt about it. There's the infant industry argument, which we talked a bit about, where the United States helps other countries who may not have the type of infrastructure and education and telecommunications and transportations to create a good economy. So we and other countries would allow that country to have tariffs or quotas that prevent imports from coming in and taking over their industry and allow their exports to go to other countries in more favorable terms. The hope is that over time that country grows its economy and then could buy from other countries, as we've mentioned a number of times. There's dumping. That's where you sell a good or service below the charge price at home. You do that intentionally. You want to run other competitors out of business. For instance, if you're selling a Coca-Cola and it's $1 in the United States and it costs $1, let's just say Japan, but Japan's going to sell it for 50 cents. Obviously, the U.S. producers can't compete. They may even go out of business. And Japan may do that to run the United States competitors out of business, and then they go back to charging $1, $1.50 because there's no competitors. And so you have to be very careful about dumping. And then they also have what's called protection of jobs. That all makes sense, right? That's where you deliberately have a tariff or a quota so that you can protect products at home. The flour industry comes in. But in many of the cases that we study, when imports rise, unemployment falls. So necessarily having more imports doesn't reduce an economy unless it is completely unfair. Then it could. Then it absolutely could be destructive to a country. The cost of protecting U.S. jobs, we used to have some restrictions on textiles and apparel goods, which means we don't allow as many goods to come in to the United States. And it costs consumers about $9 billion a year. They pay more because we have a tax on imports. Japanese cars, it costs about $160,000 per year for each job saved in the auto industry. So if we have a tax, some type of restriction, then it is going to cost monies on our auto industries. Same with glass and steel. We talked about quotas and tariffs. The U.S. wants to eliminate all tariffs. The U.S. has one of the strongest economies, if not the strongest economy in the world. They can afford to eliminate tariffs because they have a very smooth running, efficient, and effective system. Other countries don't. They still want those tariffs and quotas so that they can build that country. We have continued to eliminate our tariffs. We want to leave you with this thought, though, that free trade, that we want free trade, but we also want fair trade. We've shown that trade benefits both the importer and the exporter. The goal is to make sure that if you do produce terms that are more advantageous to the importing country, that's only for a limited period of time. That country uses the additional monies that they receive to rebuild and build their country. So that at some point in some place, the U.S. can now resume sending exports to that country. Thanks, everybody. I always look forward to our discussions. Take care.